Hey everyone, how's it going? My name is Richard and welcome back to the Traderline channel. Now in previous Tuesday tutorials, we've talked about the relative strength line indicator, the enhanced volume indicator, as well as how to analyze specific price bars during a stock's run to determine whether buyers or sellers are in control. And in this video today, we'll be putting together the last piece of the puzzle and talking about the age-old question, what is the best moving average to use? Now, before we get into the specific time frames and all of that, I do want to address the main uses for moving averages. So the way I see it, there's two main uses. The first is trend analysis, whether a stock is in an uptrend, downtrend, or just chopping back and forth. And the second is when you already have a position in a stock and you want to basically manage it using objective sell rules. So in addressing the first question of trend analysis, in my opinion, the best thing to do is have 2 to 3 moving averages of different time frames, say a 10-day simple, a 20-day simple, and then a 50-day simple. And that way you get a sense of over those time frames how the stock is performing by looking at where the stock's price is relative to those moving averages and the overall trend of those moving averages. So if the stock's price is trending above a rising 10, 20-day, and 50-day, that means during those time frames, the stock's price is in a strong uptrend, while if it's below it, the stock is in a downtrend. So this provides basically an objective way of determining the trend of a stock. And when these moving averages are crossing above each other and below each other, that is kind of a choppy period. And that way you can kind of avoid it if you are a trend follower, because at those points, there's no real defined trend. Now on this chart right here, I've got the 10-day simple, the 23 exponential, the 65 exponential, and a representation of the 10-week moving average on a daily chart. So this is kind of what works for me. And I think this is really good because the 10-day is kind of a shorter time frame. The 23 is a nice intermediate time frame, and the 65 usually catches the majority of the overall trend in growth stocks. So these moving averages have been picked by looking at hundreds of greatest winners going back in history and basically looking at their trends and what moving averages they've respected for the majority of their strong moves. So going over to the settings here, I can show you these moving averages once again. I've got the 10-day simple, the 23-day exponential moving average, the 65 EMA, and also the 10-week moving average. And these moving averages, I think, are a great place to start. But obviously, if you want to use a 21-day exponential moving average, which I sometimes use, it's not going to be super different than this intermediate term moving average. But in general, I think it's great to have a pretty short term, maybe an 8-day, 10-day, a kind of intermediate term, 20 to 25 exponential, and then a longer term 50-day 65. And then obviously a 200-day is great for the overall trend of a stock. So play around with this. And another way to determine basically what moving averages to use is you want to go back and look at a stock's price chart in history and find a period of time where it had been respecting moving averages, trending nicely. And for instance, we've got SQ, which had a beautiful run since its IPO right here. And during this time, it respected the purple line really well. And then when it did pull back, it respected the 65 EMA. And during its strongest periods, it trended above the 10-day pretty much right until intermediate tops. So going forward in history, it makes sense to use those same period moving averages to manage a trade or look for a potential buy off support. So in short, go back in time, take a look at a stock's previous run and find moving averages that had been support in the past, and likely the stock will keep that same character. And to go over to a few more examples, we've got Zoom in 2020, and this had been a recent IPO. It didn't really have much price history to look at, but during this run, it bounced off the 10-week and 65 EMA several times during its run, right here, and also right here. So going forward, this might be a good group of moving averages to use. And during its strongest moves, it really trended above that 10-day simple beautifully and basically didn't break it until that intermediate trend was done. So after a strong breakout, I find that many growth stocks obey that 10-day basically until they're ready to form another base. So that's an example of Zoom. You've got the 10-day simple. The 23 exponential doesn't do too much. You can see it violates it here, and here. But this stock really showed a clear respect for the 10-week, 50-day, as well as the 65 EMA and the 10-day during its strongest periods. Going over to another example, we've got NEO, which during its run, basically from this point, didn't close below the 23-day exponential moving average until the stock was very near its intermediate top here. So the 23 exponential, when a stock is really trending, I find works great for the majority of growth stocks. So definitely go ahead and try that one out. Next, we've got an example of Peloton last year, which also trended really nicely above the 23 exponential. You can see multiple pullbacks to that moving average, nice hammers off that moving average right here. And basically until it was forming this base, didn't close below this key moving average. Now, when a stock is pulling back into a moving average that had previously been support, you don't want to just buy blindly because it's near this particular level on the chart. What you want to do is analyze the price action. How is the stock coming back into the moving average? Is it on low volume? Is it on high volume? And basically the ideal situation is the stock is drifting slowly back into the moving average on very light volume, suggesting that there's not a lot of distribution coming into play. But if a stock is falling like a rock and in 1 and 2 days it goes from an intermediate top all the way back down to the 50-day simple, that's not really a gentle pullback to the moving average. Instead, that's more likely distribution. So that is an example with Peloton. And I also want to talk about TDD, which basically had, once again, the character of obeying the 10-day simple after a strong breakout, like right here. And also during this breakout, it obeys the 10-day nicely and basically holds it until this day right here, which is a good example of something you don't want to see as the stock is pulling back into moving averages. So here in 1 day, we were down 10.5%, it looks like, and just slicing through moving averages that it had previously been respecting. So this is, once again, a good way to manage your position, because if a stock has previously been respecting the 10-day, the 23 exponential, what have you, once the stock basically starts closing below that key moving average, it's a change in character in the stock's run. And basically it might be forming a longer term base like TDD, and it might be the start of a time where the stock is just chopping about without really any trend. And as trend followers, what we want to do is be involved during the uptrends, but not so much during the basing periods unless we have a significant cushion or for a longer term holder. So pay special attention when a stock starts changing character, breaking key moving averages that it had been respecting during a stock's run, and generally becoming wide and loose around those key moving averages, because that suggests there's kind of no real institutional support just yet, and the stock is going to need some time. So overall, that's a quick run through of how to choose which moving averages to use when it comes to trading growth stocks. And once more, I'll show the ones that Traderline likes to use: the 10-day simple, 21-day simple, the 23 exponential, the 50-day simple, the 65 EMA, and the 10-week moving average as well. And if you want the links and to be able to use these indicators that we have on the screen right here, the relative strength line, the enhanced volume indicator, as well as these moving averages, the links are completely free and they're down below in the description. And maybe in a future video, I'll talk about these green diamonds right here, which signify a launching pad characteristic, which is extremely, extremely important and shows up right before many stocks, nice uptrends and breaks out of bases. So I hope you guys enjoyed this video. If you did, go ahead and leave a like down below and subscribe if you're new to the Traderline channel. And I'll see you guys in future videos. Thanks.